Okay, let's talk about municipal bond interest. So first of all, what are municipal bonds? Municipal bonds are uh, they are debt securities issued by states, cities, and counties and other government entities to fund day-to-day obligations and finance capital projects such as buildings, schools, highways, or sewer systems. What's special about municipal bonds is that the interest income is tax-free. So why not just invest in municipal bonds since it's tax-free? Well, because municipal bonds typically pay at a lower rate than taxable bonds. So this gives us this equation for a tax equivalent yield. You take your tax-free rate, you divide it by 1 minus the marginal tax rate, and that's going to give you your tax equivalent yield. So, for example, if we have a taxpayer in the 24% bracket and a municipal bond paying 3%, then we come out with the tax equivalent yield being 4%. Now, what this tells us is this: if the taxpayer can find a taxable yield of greater than 4%, he should invest in the taxable security. If he can't get a taxable yield of greater than 4%, he should go with the tax-free yield. So sometimes you come out ahead getting a lower interest rate that's tax-free. Sometimes you come out ahead getting a higher interest rate that's taxable. So this equation is very handy. So higher income taxpayers can often save taxes and increase after-tax return by investing in tax-free bonds. And the higher the tax bracket, the more likely they are to come out ahead by going with the munis. Okay, this education is also in this chapter. We're not going to spend a lot of video time on it, but when you read about 529 plans and Coverdell education savings accounts, pay particular attention to what education expenses are considered qualified, who can be the beneficiary of the education spending, how much control the donor has, how much can be contributed, and what the phase-outs are. And you've got this link to Saving for College in eCampus. There's some quiz questions that you're going to find the answers to by going here to this website. And one nice thing about these education plans is that you can contribute to them. Now, the contributions are not tax deductible. However, the funds in there grow tax deferred, and if the money is withdrawn and used for education, it's tax free. So you get tax free growth on your money if they're used for education. If not, you will pay tax on it if you withdraw them and don't use them for education. At any rate, let's say just a couple words about Coverdell education savings accounts. The max an individual donor can contribute to a beneficiary in any one year is $2,000, subject to an income phase out. So $2,000 is not a lot of money. It may be as much money as many people could put in, but you're also going to have a lot of clients that could put in a whole lot more than $2,000. And the max that all donors combined can contribute to any one beneficiary in any one year is $2,000. So Uncle Henry can't contribute $2,000 and Aunt May $2,000 for junior's education. The total can only be $2,000 in any one year. And the amount that any particular donor can contribute is subject to phase-outs based on AGI. So Coverdell really is really an instrument for lower income taxpayers. $2,000, it'll work for a lot of clients, but your upper income taxpayers, it probably won't work for. So 2000 is all, folks. So do save for education in education favored accounts rather than giving the funds directly to a child, like in an interest bearing account or a trust account or something. So using the contributions and the growth in the account for qualified education expenses will mean that the growth will never be taxed. Let's talk about the net investment income tax. Okay, net investment income tax. So here's a list of investment income: interest, dividends, capital gains, rental and royalty income, non-qualified annuities, income from businesses involved in the trading of financial instruments or commodities, and businesses that are passive activities to the taxpayer. Okay, so this is investment type income that we're talking about. And as you can see, in addition to any other tax that is owed on it, we have an additional tax on this of 3.8%. 3.8% of something. Okay, here's how we are going to calculate this net investment income tax. We're going to take 3.8% of the lesser of net investment income or your modified adjusted gross income over those threshold amounts. So you're going to make two calculations, the number one and the number two. You're going to take the lesser one and multiply that by 3.8%. Here are some examples of calculation of the net investment income tax. I don't really think there's much point in me reading this to you, so please pause the video and read these. And if you have any questions about where the numbers come from, please let me know. Okay, sometimes you can reduce or avoid the net investment income tax. It is December 1st, Sam comes to see you because it's time to rebalance her portfolio. Upon examining her numbers, you notice that Sam has unusually high income this year for her, which puts her close to the MAGI threshold for this NIIT. Now, the stock market has done well this year, so rebalancing will create some taxable capital gains and push her into being subject to the net investment income tax. So what would you advise her to do? Maybe you should consider waiting until January to rebalance the portfolio. She might still be subject to the net investment income tax, but we could put it off for a year because the income would occur in a different year. So consider waiting to rebalance the portfolio. This will avoid the NIIT currently, and if her income is otherwise lower in X2, she might be able to avoid it entirely. So, income tax planning for clients on the edge of being subject to the net investment income tax. Look at possibilities for the timing of income to keep them below the limit. Okay, refresher for municipal bond interest calculation. Jan is in the 37% tax bracket for federal purposes and the 10% tax bracket for state income tax. She is considering an investment that would pay interest at the rate of 5% tax-free. What is her tax equivalent yield? So please pause and figure that out. The answer is 10.16%. How did we get that? We take the tax-free rate. We're going to divide it by 100 or 100%. We're going to subtract it. From the 100, we're going to subtract her tax bracket. Well, the federal tax bracket is 37%. The state is going to pay an additional 10%, and someone that's in the 37% tax bracket has income high enough that we can say confidently that they will be subject to the net investment income tax. So don't forget to include the net investment income tax if applicable in doing your municipal bond calculations. All right, let's talk about gifts. How much can I give to someone? This is a really, really common question. Couldn't resist this dog picture. I love this. How much Benadryl? Well, how much can I give to someone? Well, the truth is you can give as much as you want. I mean, the real question is, and some people know this and some don't, how much can I give without having to file a gift tax return? People become aware that there are limits on gifts, that they don't really understand how it's taxed. So for our purposes, this is what we're going to tell them, how much they can give without having to file a gift tax return. And you can't give as much as you want unless you're willing to file a gift tax return. Now, what is the annual gift exclusion? This is the amount that any donor can give to any donee without filing a gift tax return. And of course, later on in the class, we're going to learn more details of this. But each donor can give up to $15,000 tax-free per donee each year, each donor and each donee. So here are Mr. and Mrs. Smith. They want to give each of their three grown children some money. So how much can they give without filing a gift tax return? So you're not going to file the return. You're not going to owe any tax on it. Well, Mr. and Mrs. Smith, each donor can give each donee, each of their three children, $45,000. So This is a lot of money without even filing a gift tax return. And if those children are married, they could each, Mr. and Mrs. Smith could each give each spouse $15,000. So it adds up. Okay, this textbook also discusses income from personal activities. We won't discuss all of these, but we are going to discuss imputed interest below market loans. Okay, here are your clients. Daughter Haley wants to buy a home and she can get a mortgage at 4%, but of course she is just starting out. And Mom Becky has cash in savings and Mom is only earning 1% on her savings. So they come up with this idea to help each other out. Becky will loan the money to Haley at 1%. Therefore, the mom's not losing anything, and the daughter, Haley, is going to get a great interest rate of 1% instead of 4%, which is what she could get commercially. Now, Haley is going to have total investment income of $5,000 each year, and there are tax issues here. All right, and the tax issue is that we have a below market loan taking place. Now, this loan that Mom made to daughter actually is partly loan and partly gift. She loaned her $100,000. The commercial rate is 4%, and so there's 5%, $4,000 of interest expense that daughter would pay with a commercial loan. The daughter is only paying $1,000 because of the 1% interest, and the difference of $3,000, actually what is happening here is a gift from the mom to the daughter. And this $3,000 difference is what we call imputed interest. So what physically is happening here is that Haley pays $1,000 deductible interest, which will be an itemized deduction if she can itemize, to Mom, and Mom has $1,000 of reportable interest. But here's what's happening in spirit, and the IRS likes to tax things in spirit. What really happens is that daughter Haley has $4,000 deductible interest, itemized deduction. Mom has $4,000 of reportable interest income, which of course she didn't get but $1,000, but she has to report the whole $4,000 because the difference of $3,000 really was a gift to Haley. Okay, the AFR is the applicable federal rate, and this is a rate that the IRS supplies. You look it up online. Interest rates to use for this calculation of imputed interest. So recalculate imputed interest is if the AFR is 2.5%. Well, in that case, the AFR is 2.5. So if Haley was paying the AFR, she'd pay $2,500 in interest. Mom is only charging her $1,000, so the difference of $1,500 is a gift. And so Mom would have to report $2,500 of income and assume that this $1,500 is a gift. So how much will Mom Becky report as interest income? $2,500. How much will daughter Haley deduct as an itemized deduction? If she can itemize, she can deduct $2,500 as an itemized deduction. So, the loan gives Haley a cash flow. It gives her a larger itemized deduction than otherwise. Becky has higher reported income than she would otherwise, but she may want to do this anyway because it's helping her daughter. Now, they need to be aware of the annual gift exclusion. Of course, these numbers are way below the $15,000, but these loans can get a lot larger than this too. So be aware of the gift tax exclusion. And there's some exceptions to this imputed interest rule, so look this over. So, income tax planning principles for clients considering below market loans. Make sure they stay within the law by using the correct AFR. Make sure they are aware of the gift tax annual exclusion for individuals and tax consequences of the transaction.